Welcome back to Market Matters presented by MyX. Today's episode is one you don't want to miss. We'll be talking about a problem crucial to this market right now. The Federal Reserve has a credibility crisis. But before we dive in, make sure you hit that subscribe button, ring the notification bell so you never miss out on the latest episode we have coming out. Now, let's get down to business. The Fed, led by Chairman Jerome Powell, has been at the center of attention lately, and not for the right reasons. It seems like the Fed has lost all credibility, leaving investors scratching their heads and markets in a frenzy. Just yesterday, Powell's appearance on 60 Minutes threw cold water on market expectations of rate cuts for 2024, sparking even more uncertainty. Despite Powell's efforts to push back on expectations, the market isn't buying it. While the Fed has stated only 2 rate cuts are on the horizon for this year, the market is still pricing in a staggering 5. The lack of faith in Powell's guidance is evident, with very little respect being given to the Fed's projections. What's more, the Fed's ability to influence long-term rates, which is a significant impact on inflation, is limited. They can only set their benchmark short-term rate, relying heavily on their credibility to steer the market in the desired direction. As Powell himself admitted, integrity is priceless, and in the end, that's all you have. We plan on keeping ours. But the big problem remains: has the Fed lost all credibility? Brian, what do you think? Has the Fed lost some credibility?
They have. Their credibility is going to zero. And I can't wait to spend more time on this in the show. We got a great show coming up. We're going to talk about the Fed. We're going to talk about some other things. Palantir earnings coming up this next week. That's going to be huge. Cybersecurity is a big deal. So we got a great show. I really want to jump into what the Fed is doing because we've got some good volatility insight on all that. So really stay tuned into the show.
Yeah, let's get right into it. We got a lot of Fed speak this week. They are coming hot and heavy. Every day we're going to have some Fed speakers. Not a lot of economic reports out there. We'll be looking at the initial claims on Thursday a little bit, but CPI revisions a little bit. But it's all going to be down to these Fed expectations. We were talking about it last week a lot. A huge week last week that really set the tone. Not a lot to report here on some of these contrarian indexes. Last week, Brian, you brought up this fear and greed. This was at extreme greed right here in the CNN fear and greed index. Last week was an all-time high in the market. Is that going to turn out to be an all-time high that we're going to see for a few months or longer? We'll see.
I think when you look at that greed index there, obviously volatility is a big thing that we're trading and looking at all the time. And, we've seen volatility now dip into the mid-teens. It's kind of bounced back and forth from 12 to 15 on the index levels, depending which one you're looking at, whether you're looking at the spikes or the VIX or whatnot. And so that's factored in there. And that's maybe an indication that we are a little greedy here. This has gone on for quite a bit of time, but the market continues to run. So, maybe there's more to go.
Yeah, and the reason why we pay attention to this index is, you go back in time and you look at just last year, October, that was a good time to buy in the market. The high in the summer was right here. You go back, last year you had the regional banking crisis right here. Basically, it's another way of saying when there's blood in the streets, it's when you want to buy. When everyone's greedy, that's when you want to sell.
Yeah, the only one thing that I caution to people is that despite we're going to get into this here, the Fed watch projections, when you take a look at that was 50-50 right before the Fed meeting. Joe, I think we have a slide to show what they are now. Yeah. And I would have expected a shift where we saw this bump up in expectations of the Fed maybe not cutting and that being very bearish for the market. But the market really shook that off very quickly last week. That to me is a pretty bullish sign that maybe there's some legs more to go to the upside despite this over greed that we talked about.
Well, let's bring it into the big story. We are talking about the Fed this week in the big story. Last week, huge week. We said this was on the line, 50-50 for March going into the Fed meeting. Today, after the 60 minutes, after their meeting last week, we are at 1585. So basically, we're not getting a cut in March, and the Fed does a good job of telegraphing. So this should be the expectation. No cut in March. But, if you look out on the dot plot, this is the dot plot versus the futures here for what the market's expecting. The Fed for 2024 is saying 2 cuts. We're right here. That's their baseline, 2 cuts. The market's all the way down here at 5 cuts. So the market's still saying 5 cuts are coming for the calendar year. Now, you just say, hey, the market's always pessimistic. The market bullish, I guess. The market's always pricing in more cuts. Well, if you go out into 2026, they're actually higher on interest rates than the Fed is on their dot plot.
Well, I mean, from that, you would say that the Fed just has really no well-communicated thing with the rest of the market. Maybe that means they are losing credibility. I know I kind of joked that their credibility is going to zero, but in reality, maybe the market's got it wrong, really. When you look at it, the market has been very dovish in terms of rate cuts, in terms of interest rates not going as far as they can. We continue to see the 10-year note down around that 4% level, yet the Fed funds rate is up around 5%. So there's really been this huge disconnect. And I think the market has had trouble actually doing what the Fed is trying to say. And actually, this is the one time I really think the Fed maybe is correct. Inflation is not down to 2%, despite what Joe Biden tweets about constantly that, oh, we're at 2% and just tells these lies out there. That's not true. What we are seeing basically is that inflation has stayed above 2%. Gundlach was on after the Fed rate decision saying that, PPI numbers are down low, back to zero. No, that's not true. We still have inflation. The Fed wants to be cognizant of it. They're holding rates higher. They probably are right to do that until we see inflation drop. So the market has gotten way ahead of it.
And this question was really asked the question asked when they got this quote from Powell was, are you going to lower rates because it's an election year? Are you going to feel that political pressure to lower rates? The market kind of is saying yes. The market's kind of saying you're going to lower rates, even for everything that Powell has said. Now, Powell wishes the 2024 rates were higher. They wishes that he could lower them while the rates were still higher. He wants the market to do what he says, not what he does. But the market does not think so. And, you go back in history, election years tend to be bullish for the market. The party in power seemingly does well. And maybe he's right. Maybe it's not political in terms of like a Republican Democrat political party thing, but there is a geopolitical component to it, which it always is political. He wants the best for the American economy. He wants us to compete around the world. And there is a lot of geopolitical flashpoints out there around the world. We have an up-and-coming great power trying to overtake us, as well as a war going on with another great power. So there is that geopolitical pressure to make a strong American economy.
Yeah, and I mean, I will say this. One thing we like to do as traders, and I think people tune in to listen for, is what's volatility in the market going to do? Should people trade options? Should they own options for protection right now, based on how the Fed is sort of wishy-washy relative to what the market wants? They could, again, I think they're right in holding steady here, not decreasing rates. But yeah, you look at that seasonality chart, Joe, and to me it says we could be in a little bit of heat for an upside volatility explosion, because when we look at the spikes index, when we look at other volatility indices, we tend to see that when the Fed becomes a little hawkish, that tends to make things a little bit more dislocated in the market, and seasonality does not look great for that picture.
Yeah, and really, I mean, maybe this is one of the things we brought up last week. Another reason to watch every week. We brought up the possibility the Fed could be hawkish, get that expectation in line for fewer rate cuts, and then you might see some volatility in March, and then the market will say, we need a cut, and the Fed will come around, to their cuts later in May, like currently is priced in. So we'll see if that comes to pass. But historically, right now, around all-time highs, volatility is still relatively low. It's a time to be cautious, keeping your head on a swivel, making sure everything is protected.
Yeah, and I would just caution people to remember, in February 2007, February 14th, I remember this because this is when my oldest son was born. It was on that day. The VIX actually hit a level below 10 on that day, and then obviously the credit crisis happened, a year later. So volatility can change very quickly when you least expect it. That happened in mid-February. We're sort of heading into that period where, we do see this volatility index come off a little bit, come lower in Feb. Today's a great picture. Market is down earlier today. The volatility indices were down. Volatility futures were trading lower as well. And when those go down and the market goes down, typically that's actually a bull sign that people are selling puts and taking their insurance off. So maybe we get a little ride up to the upside post earnings here. Picture for a couple weeks, but then let's be careful, especially if the Fed is hawkish.
I'll say post earnings. It was a good earnings week last week for the big major players. Friday was fascinating though. You had the market was up higher than 1%, Brian.
Yeah.
led by Meta, Facebook, led by Amazon. But over 50% of the companies were down on the day. So we had a 1% return on the index, but 50% were lower on the day. That's pretty unusual. I think that's a sign that volatility is ahead.
Yeah, and I mean that maybe is an indication why all these Fed futures are trading lower than the Fed, because the most of the market needs a Fed cut for them to do well. They've all been struggling except for the big tech, which seems to be taking control of this market.
All right, let's bring it on to the big trade, or the trade of the day. Let's look at the earnings for the week. There is a lot of earnings this week, Brian. I pulled out my favorite each day. We have Palantir, Chipotle, Disney, Expedia, and Pepsi this week. Take a screenshot of this if you want to see their implied move versus their historical move. A lot of big movers out there for sure. Should be some interesting trades to say the least. But Brian, anything pop out, and what do you want to trade?
Yeah, I think the most interesting one here on this list is Palantir. This is basically cybersecurity. This is, all the warfare that we're having right now, Ukraine, Russia, Middle East issues. Palantir really is in play. And I think this is an interesting one, Joe. When you look at the level of volatility, right, the implied move of 14% after earnings is massive. And historically, this thing has moved about 12% per earnings. This is going over the last average over the last number of quarters. So this is a one where when we get this level of volatility, I probably want to use some option trading strategies around that. Let's take a look at this chart right here. When you look at it, had a very nice head and shoulders bottoming pattern a few months ago. It sort of turned, it broke out to the upside. It's now trading at 16 and change right now. You see some of these levels of support and resistance. What's interesting here is if we zoom in a little bit on this chart, we're sitting right around 1670. I think we could get back above this 20 level and break through to the upside. The downside support is more like around 13. So a $3 or more move is pretty massive. That's almost a 20% to the downside. So I'm looking for a stock replacement idea here. I'm going to trade some options here. I'm going to use a call spread. With the stock trading around 1670, I was looking at this, the Feb 17 call that expires next Friday. I can buy that for only $1.25, and I can sell the February 20 call for 40 cents, net debit of 85 cents. This gives me a break even of 1785. So from 1785 up to 20, where I'd be called away, I would profit from this trade. But I do need it to get to that level to cash in. If the stock trades lower after earnings, I'm out that premium of 85 cents, which is, that's a decent amount, but given the fact that this thing could move 12, 13, 14% like the options market is predicting, that's not a lot of premium to outlay. And so this would be something where if I have some sort of account where I can be tradable and flexible, I may be looking to replace my stock here and add options trades.
Yeah, you got a call spread. Remember, stick around for the end of this show. We'll be talking about call spreads and options 101. But basically, Brian, you got a strike where you'd be willing to be flat, Palantir up higher, because we're looking at this implied move, like we said, not really expecting, a 50% upside move. You're just expecting a, range bound move, a normal move, and using the historical patterns to your advantage.
Yeah, and I think Palantir, when you look at the valuation on this, it's kind of it came out, it IPO'd, everybody was excited about it. Then it really got stuck in the mud. And I think with all the conflict and all the geopolitical risk out there in the world, this is a stock that's probably going to hang in there and deserve some sort of portion in a portfolio that wants some level of diversification and some level of risk to defense, U.S. defense.
Yeah. So speaking of the IPO, I had this COVID era, not really real valuations right there. We've done really good consolidation, 2022 through now. Really rounding up 20 seems to be kind of an area of resistance. I kind of see in this chart too, but I think it's made a nice base, looking to trade higher and reach those higher levels.
Nice. Yeah. So, we got that. Get the call spread on. That's what I'm going to be looking to do ahead of this earnings play next week.
Yeah, let's move on. By the way, thanks everybody again for joining in. Everyone watching live, you are great. We love you all. Remember, you can send us any questions that you want. We do have a question here coming in from Kyle. Question we have last week. You talked about big earnings in technology that came out. Are you repositioning yourself given what was said?
Yeah, so we saw early in the week, obviously, we saw some stuff with Microsoft and the likes. Later in the week, Joe, you mentioned Meta. That obviously jumped higher. We're really staying with the NASDAQ 100 in general. We're sticking with that trade. It's a strategy we do. We stay long these technology names, but we stay hedged using S&P options. So it's almost like a long short kind of trade where we stay long this NASDAQ 100. We get shorter the market with S&P 500 names by using puts there. We use volatility future contracts as well to keep ourselves hedged. So we're trying to continue to stay that course. I think that's the way to play it. There's really been this paradigm shift into tech. We talked about it. These are the big movers and the players, and I think you want to have some overweight exposure to that. What do you think, Joe?
Yeah, back to what was said for earnings. It seems like some companies have done better than others, obviously, but a theme has been people are spending more money on AI, and it's starting to hurt them their bottom line and their earnings. Where that spend is continuing. It happened a lot last year. It's going again this year. So we're still investing, maybe consolidating this huge AI craze that we have. Nvidia's big beneficiary. They continue to just rock and roll. They're not going. They seemingly are go up 3% every single day. But a lot of other companies are just spending money on chips and just building out that AI. And this really could be a story of some will make it, some will benefit off of this AI. I think the companies with the data are going to do the best. Maybe that's why Meta was so fantastic. But and some will hurt.
Yeah, and I will also like to touch on the fact we gave a trade. We talked about tech in the earnings last week, but we also gave a trade on the SPY, a strangle that was expiring last Friday. And we talked about how cheap volatility really is. I mean, we said this at the top of the show, volatility can creep in. We saw the realized move. Buying that strangle like I did, we saw the market swish down. I had a chance to take the put side off of the strangle. Then the market rallied all the way back up through the long call strike, and I had a chance to take that off as well. So you're going to get some realized volatility movement, and I think sometimes traders have just been so hard to chase shorting volatility that it has presented opportunities. When we get a big event, lots of things going on last week, there was huge amounts of volatility to trade back and forth, and I think we played that one pretty well. That strangle's come off the board. I'm on to the next trade. That was that week. Now I'm going to be looking at things differently this week. Obviously, Palantir is one that I'm watching for the earnings play next week.
Let's see how we do. We're on fire, Brian, with these calls. It's just
amazing. Yeah, we have nailed it. So stay tuned. We give some good trade ideas, don't we?
All right, here we go. Options 101. What is a long call spread? Well, very simply, a long call spread is buying a call on a strike and selling a call on a higher strike of the same expiration. It is a trade we'll put on when we think the stock is going to be going higher, and it'll be a cheaper way to buy a call rather than just buying a call outright. So let's take a look at it visually. Here are the two positions we have. We have a long call. Remember, you spend money on the call, and you have you go up and up and up. The higher the call goes. Then you have a short call at a higher price. You get to collect the premium on the call, so the stock goes down. You make money, but you lose money the higher the stock goes. And if you put it together, you have a long call and a short call. These two are going to wash each other out to look like this. This is your long call spread trade. You are not expecting a huge move to the upside. You are expecting the higher move, and it's cheaper to buy this call spread rather than just a call.
Well, Joe, that's our Options 101 segment. You always do a great job of simplifying it and teaching people on how to trade options. That's a big part of what we do. This is Brian Stutland here from Equity Armor Investments with my colleague Joe Teague. Fantastic show. Check it out. We got a trade for you. You can replay it. Check us out on YouTube. Remember, subscribe, like, do all that kind of fun stuff with us. We really give some good insight on the market. We thank Tradier Hub for broadcasting this show and the sponsorship by the MIAX. So great show. Tune in next week, same time, Monday afternoon. We got more for you.